Another record-breaking day on Wall Street with the Dow and the S&P both closing at new highs. And joining us now to share some of the areas where she's finding opportunity is Olaolu Aganga. She's Mercer's U.S. Chief Investment Officer. Great to have you back here with us. And we've been talking so much about tech. And I was talking to Pippa Stevens earlier about the relationship, or maybe lack thereof, between tech and energy. Energy as a sector has not been doing well. Yep. With the investment flowing into energy infrastructure, might that change?
Definitely. I mean, where we've been talking about with regards to infrastructure has been a focus for quite some time. We mentioned in the last segment that we had our clients are looking to allocate more to infrastructure. We've seen M&A deals. In the last 6 months, we've seen 4 deals with regards to firms focused on infrastructure. And then in the last month alone, we've seen about, $5 billion from a government funding standpoint on 37 major projects with regards to infrastructure. So definitely a focus area for investments, both in private and anything that's funding bridges, clean water, that type of area.
We talked to you a lot about real estate. I wonder if, since the last time we've talked, investors are getting more opportunistic and ready to jump in on these distressed properties, particularly in commercial, or no?
If you don't need to finance it, if you've got some cash, it's a great area. We're seeing vacancy rates go up. We're starting to see, with regards to development in buildings, if you're able to go and rehab some of the buildings that are out there, make sure that they're a little bit more energy efficient, you can have those leases and lease them up. But overall, lots of opportunities if you have cash. Leverage is the hard part. Rates where they are is a little bit difficult.
It is interesting to hear you say that, though, because it did feel like last year, as we started to see the first wave of distressed real estate hit the market, there were a lot of investors kind of just sitting on their hands going, this has further to fall. And it almost becomes its own death spiral, if you will. So the idea that folks are starting to step into that market, folks with cash, I think, does it signal perhaps a bottom in this cycle right now?
So at the start of the year, and everything is predicated on rates. So at the start of the year, there were actually rate cuts that were indicated, as early as March. Now that looks like that's pulled back a little bit. So where rates are and the levels of financing is almost what was indicating the ability to maybe step in. So if you have cash, and then if financing rates go lower, then that's an opportunity to start really delving into real estate. But before last year, it was up. It was an upward trajectory with regards to rates.
Whether it's real estate, whether it's infrastructure, I mean, it sounds like we're talking about private markets as the place where the biggest opportunities are. Is that true?
Continues to be private markets, because in public, S&P and the Dow reaching all these highs, but it's a narrow breadth. So where you're seeing a lot of the opportunities with regards to public markets is still a few stocks, very select areas, AI, as we're looking at it, but private markets is a lot more.
But if you have cash and rates stay higher for longer, wouldn't that mean you have less competition in going after some of these properties you might want? Because, you don't have to deal with the people who need the leverage, just the people who have the cash. Or am I thinking about that wrong?
No, that's precisely the way to be thinking about it. So you have less competition. I think last year we actually saw a good amount of investors start increasing their cash piles. So there are a good amount of investors that have cash sitting on the sidelines, have been dipping their toe in, and this is a great opportunity to do so.
How much do the market dynamics, public, private, or across sectors, whatever you have it, how much does it shift when we actually do start to see the realization of rate cuts?
Not everyone has the opportunity to do private markets, as we know. If you do, then that's great. That's where the opportunity is. But if you don't, then you look for some of the tangential areas that are related. We've talked about REITs. That's one of the areas that we've mentioned with regards to opportunity in sector areas, and then anything infrastructure related that are tied to buildings and developments. So those are the unloved areas. Our focus right now is looking at some of the areas that are beaten down and looking for them to revert through time.
How much do you expect to be using artificial intelligence to scout out those opportunities over the next 1 to 3 years?
AI is a big area of focus, not just for Mercer, for many, many, many other firms. The opportunity to increase productivity, reduce costs is great. So we are investigating the use both in-house and in other firms, are really looking how you can integrate that in your regular processes for some of the tasks that could be a little bit monotone.